Hello students, welcome to Accounting 1304, Introduction to Accounting 2. This is Dr. Mercado with you today, and in today's lecture we are going to be covering content from Chapter 14, which deals with adjustments for a merchandising business. Like every week, I do want to remind students to please make sure to read the entire chapter before attempting any of your assignments. Now, in addition to that, we are going to be dealing with adjusting journal entries, okay? Adjusting journal entries were covered in Introduction to Accounting 1. In this particular chapter, Chapter 14, we're going to be learning adjustments specifically dealing for merchandising businesses. But some of those adjusting entries have already been previously covered in Introduction to Accounting 1. You do have access to the ebook. If you still need or require a refresher, please make sure to go back to the introductory chapters and review the chapter that deals with adjusting journal entries. Now, what I love about this particular ebook or textbook is that you are provided with a wealth of examples. So please make sure that you do look at that, even though some of those journal entries are not being covered in Chapter 14 because they've been covered previously. They still illustrate how to complete them. Okay, so the exercise that we're going to be covering is exercise 14.08A, and it deals with adjusting entries. Let's look at the problem. Okay, so we are provided with an end of period spreadsheet. This is a partial spreadsheet. So we are being asked to journalize the adjusting entries for a merchandising business. So it says the following partial spreadsheet is taken from the books of Giovanni's Vegetable Market for the year ended December the 31st. We are to journalize the adjustments in a general journal. Okay, so this problem is not very difficult because they've already done all of the work for you. They've already prepared the adjusting entries for you. Now, the adjusting entries are being reflected on the spreadsheet, but we need to remember that those adjustments are not valid until they are actually posted into the journal. Okay, so just preparing the spreadsheet is not enough. After the preparation of the spreadsheet, we need to transfer that information into the general journal because that is what makes the actual journal entries post into the different systems and into the different accounts. Okay, so we're going to start off with letter A. Okay, so we're going to go in sequential order. That way we don't lose focus of what we're doing. Okay, so the letter A impacts merchandise inventory and it impacts income summary. Okay, now if we look to the ebook, okay, they talk about the specific types of entries. Okay, so there's a review of the entries for the purchase and sale of merchandise. So when you purchase merchandise, you debit purchases and you credit either accounts payable if you purchase on account or cash, depending on how you paid. Okay, when you sell your merchandise, okay, you debit your accounts receivable or cash, depending on how they paid you, if they're going to pay on account or if you received the cash, and you credit your sales. At no point do we touch merchandise inventory when we either purchase or sell the merchandise. Therefore, we have to make an adjusting entry for that. Okay, so it says here, note that the merchandise inventory account is not debited or credited in neither of the entries. Okay, since sales, purchases, sales returns, and purchases returns have taken place during the year and have not been entered in the merchandise inventory account, the beginning balance of the merchandise account no longer provides an accurate measure of the inventory held at the end of the year. Okay, so there's a lot of updating that needs to happen during that period that we didn't post any entries. Okay, adjustments must be made. Okay, it says for other assets like prepaid insurance, we would simply make an adjustment for the change in the asset account. We do not follow this procedure for merchandise inventory. Okay, now for merchandise inventory, it's a two-step process. Okay, the first step is to remove the beginning inventory from the merchandise inventory account by making the following entry. So we're going to identify our beginning balance of merchandise inventory. We're going to go ahead and we're going to transfer that balance into my income summary. We're going to debit income summary and we're going to credit merchandise inventory. Okay, so by doing that, we are zeroing out our merchandise inventory account with the balance that we had. Okay, after we've done that, okay, we're going to enter the actual ending inventory in the merchandise inventory account by making the following entry. we're going to debit merchandise inventory for the new or the correct amount of inventory that we have, and we're going to credit income summary. Okay, so it's a two-step process. So when we're looking at updating our inventory, that is going to be affected by letter A and letter B. Now, letter A, remember, it's a two-step process. Step number 1 is to debit income summary for the old amount of inventory and credit merchandise inventory for the old amount. So let's see what we're going to have here. So if we look at merchandise inventory, my balance is 45,000 debit. Okay, so step number 1, and this is happening as of December the 31st. Okay, step number 1 is to debit income summary for the original balance that we have there, which is 45,000. And we're going to credit my merchandise inventory. So what that's going to do, it's going to zero out my merchandise inventory. Okay, I had a debit of 45,000. Now I'm going to credit it 45,000. So that leaves my inventory at 0. Okay, so step number 1 is to debit income summary and then credit merchandise inventory for the amount of the original inventory that we have. So we are focusing on right here, 45,000. So we're going to zero out that 45,000 in step number 1. Okay, so that's what we did. Now, step number 2, let's go back to the ebook. Step number 2 says we're going to enter the ending inventory in the merchandise inventory account by making the following entry. Okay, so now we actually went out there, we conducted a physical inventory of the goods that we have, and now we actually know how much inventory we have at this point in time. So now that we know how much actual inventory we have, I am going to debit my merchandise inventory account for the correct amount, the updated amount, and I'm going to credit income summary for that same amount. Okay, so what happens here is in requirement, or in letter B, we figured that we had $50,000 of inventory. Okay, so we went from having 45 to having 50,000. Okay, so now we need to update our records to show that 50,000, because right now with the entry that we just did, we just zeroed out our merchandise inventory. Now we're going to go put it back into our books. Okay, and we're going to go ahead and we're going to debit merchandise inventory for the 50,000, and I'm getting the numbers from here, from letter A and B. Okay, but we're tackling one at a time. So the first one is letter A. I'm going to put here the letter, that way we know which one we're working on. Okay, so this is letter A, and then this would be letter B. Hopefully these little notations help you with the entries. Okay, so right now we're working on letter B, which is the second step when we are updating our inventory. So letter B is we have $50,000 of inventory. We have to record how much inventory we actually have, and we're going to credit our income summary for 50,000. Okay, so if we look at income summary, we're going to have a debit of 45 and a credit of 50. Okay, so that takes care of letter A and letter B. Okay, so let me go ahead and mark them off, because I want to make sure that I know which ones I've been using up. This is just me doing my visual stuff, because if not, I do not remember what I did. Okay, so those have been marked off. Now I'm going to go to letter C. Okay, so what is happening on letter C? Okay, well, letter C deals with unearned membership fees. Okay, and then the offset is membership fees. Okay, so this has to do, if you look at the word unearned, okay, unearned membership fees. So what happens is we pay for memberships in advance. Okay, we have not used up the membership services. So as we're using up the membership services, we transferred the unearned portion to the actual earned portion of our income. Okay, so we can't recognize the income until we've actually earned it, until we've actually provided the service. Okay, so in your textbook, okay, they talk about adjustments for unearned revenue. Okay, this applies to anything that is unearned. Okay, and it says so in the text. It says some businesses require payment before delivering a product or performing a services. Examples include insurance companies, magazine publishers, apartment complexes, college food services, professional sports, companies that sell season tickets, anything of that nature. If you receive cash in advance, that is called unearned revenue. Okay, the cash has been received in advance, but the company still owes for the product or the service, and you cannot recognize that money as earned until you've provided that customer with the product or services. Okay, so the unearned revenue is reported as a liability. Okay, so the normal balance of a liability is a credit. When it's actually earned, then we debit the unearned revenue account, and then we are actually earning the money now because we've provided the service or the product, and then we're actually going to recognize the revenue under the revenue account, which has a normal balance of a credit. So we would debit the unearned account and we would credit the revenue account. Okay, so in this case, we have a scenario here where $2,000 of membership fees that were paid in advance have been earned this month. Okay, so what's going to happen with my unearned membership? If we recall, whenever we are making the adjustment entry, when we are making an adjustment, we debit the unearned revenue account and we credit the revenue account. Okay, that's on figure 14.5. Okay, and that entry applies to any unearned account, whether it be unearned rent or whatever the case might be. If it's unearned, the entry would always be the unearned account gets debited and then the revenue account gets credited. Okay, so here we have unearned membership fees for $2,000. So now my liability decreases by doing that entry, and then my revenue account is going to increase. Membership fees is my revenue account with a normal balance of a credit. So now my revenue is going to increase for the month of December by $2,000. So that takes care of this one, and then that takes care of this one down here. Okay, so that's it for letter C. Now we're moving on to letter D. Okay, letter D. Letter D deals with supplies. Now this adjusting entry we have already covered in Introduction to Accounting 1. So we buy supplies in bulk and we put them in a storage unit, and then as we use up those supplies, well, the supplies diminish. At the end of the month or at the end of the quarter, depending on how your business does it, we go out there, we check how much supplies we have, and we adjust our supplies. Why? Because we've used up a lot of the supplies. So we need to record the expense for those supplies that have been used during that period. Okay, so in this case, they're in the particular scenario that we're working with, they're waiting for the whole year to do their adjusting entries. In the real world, most companies do adjusting entries every month, okay, because they want to bring all of their accounts up to date on a monthly basis. Okay, but it depends on how the business runs. Okay, that's up to the business owner. Okay, so here we had $10,000 of supplies to begin with. Okay, and then we have an adjustment of $7,000. So that means that we've used up $7,000 of supplies during the year. So that means we are only left with $3,000 of supplies. Okay, so we've used up $7,000 of supplies. So that's going to be a decrease to my supplies account. And then I'm going to record a supplies expense for $7,000 to recognize the usage of the supplies. We had to spend money on supplies costing us $7,000, okay, for the period. Okay, so this is happening on December the 31st. So what is happening? I am going to have to record my supplies expense account. I have to recognize an expense for those supplies used during the period. And I'm going to decrease the balance of my supplies because I no longer have 10,000 of supplies. I've just used up 7,000, so I need to decrease my supplies account by 7,000. Okay, so the expense account is to recognize the usage of the supplies for the period of 7,000. The supplies account, which is an asset account, will decrease to show that we started off with 10,000 in supplies. We've used up 7,000 in supplies. That means we only have 3,000 of supplies left over. Maybe it's time that we go and we replenish our supply closet. Okay, so that is letter D. Let me mark that off. Okay. Okay, let me do the other one. 7,000, letter D. Okay. Now we move on to letter E. Okay. Oh God. Okay. Okay. So now we're doing letter E, December 31st. All of our adjusting entries are being done at the end of the month, in this case, in the end of the year. Okay. So the next one we have is letter E. Letter E deals with depreciation. Okay, so if we look here, my accumulated depreciation was a credit of 15,000, and we're going to add another 5,000. So that means that we have to record the wear and tear of the depreciation of the building. Okay, so my accumulated depreciation account, which is a contra asset account, will get credited, and I have to recognize the expense for actually using the building by debiting it. Okay, this was also covered in your Introduction to Accounting 1 course, so we should be familiar with this from that point. Okay, so what are we going to do? We're going to debit depreciation expense. Remember, expense accounts are always debited, and the amount is 5,000, and we're going to credit our accumulated depreciation for the building. Okay, for 5,000. Okay, so what's happening under the depreciation is basically we've used up. How much have we used up during the year? Well, the building has depreciated based on our calculations $5,000. So we have to record the expense for that depreciation, and then we're going to credit the accumulated depreciation, which keeps track of its usage. Okay, it's losing value in our books based on the depreciation. Okay, so that is letter E. And remember, depreciation does not really correlate with the market value. It's just a method for us to deplete that as, how much have we been using it, and based on its use, it is losing value. So we are assigning it a number of the value that it's lost based on a calculation, and that is the number that is provided to us here. Okay, that is letter E. So let's mark that off. Okay, and let's do the other entry for letter E. And then last but not least, we've got letter F. Okay, letter F, December the 31st. Okay, letter F deals with salaries and wages payable and salaries and wages expense. So what happens is it's the end of the year and it's a Wednesday. Okay, what we do is we usually cut checks on Fridays. Okay, are we going to do a special check run to pay our employees on Wednesday because it's the last day of the year? No, we're not. Okay, we're not going to do that. What we're going to do is we're going to accrue those wages. Okay, we're going to put money aside this period, and we're going to record the expense this period because this is when our employees worked. So we have to recognize the expense in the period that it happened. Remember, the rule of thumb is we recognize revenues and expenses when they are incurred. Okay, so when did my employees work? My employees worked this week, the last week of December. Okay, am I paying my employees? No, I'm not. I'm not paying them till January, but they did work in December, so the expense needs to be reported in the month of December. So what's going to happen is I'm going to debit my salaries and wages expense to recognize the expense in the correct period. Okay, salaries and wages expense, and the amount is $1,200. Okay, and I'm going to put the money on a payable. I'm going to put the money aside. Okay, that way next month that I pay for my wages for the last 2 days of the month or whatever the case might be, I just take the money out of my payable and I pay my employees for those 2 days. Okay, so I'm going to go ahead and I'm going to credit my salaries and wages payable. Okay, and usually for salaries we want to keep those separate. Usually our accounts payable account is just for general expenses like utilities and stuff like that, anything that you have not paid. But if it's salary related, we want to keep it separate and keep track of it separate because that account should be cleared very quickly the following month. You shouldn't have or maintain a balance on it for very long. Okay, So salaries and salaries and wages payable is a liability account with a normal balance of a credit. Okay. So what I've done here is I've recognized the expense in the month of December, and I've put the money aside. I owe, that way I record that I owe someone $1,200. Okay, I owe my employees $1,200. I'll pay them next month, but the money is already there. It's been set aside for them. Okay. So those are the 6 adjusting entries that were required of us. Let me go ahead and mark them off. That way we see here that we've done all of the entries. Okay. So my recommendation as you are tackling adjusting entries is to understand what is happening in the transaction. Okay. Is something being used up? Is something, are you accruing for something that is going to get paid the following month? Is it the depreciation? What is it that it's happening? So you can be able to figure out. Now, your textbook does a wonderful job. I did not include all of the information because there is just so much information. They give you step by step of how to analyze the information on your end of period spreadsheet and complete the 4-step process. There's just a lot of information, helpful visuals. That way you can see on the accounting equation what you need to debit and what you need to credit. So it's just a matter of you locating the section of the book that applies to the problem and then gathering the data to be able to complete your part of the assignment. Now remember, debits must always equal credits. So I'm just going to make a quick check here because I want to make sure that I am in balance. And I am 110,200 for both. So I am good. So make sure that you remember to always ensure that your debits equal your credits. Debits always go on top, credits follow when you're doing your journal entries. Okay, so that is basically it for this particular problem for exercise 14A. If you have any questions or concerns as you're working your homework assignments, please do not hesitate to contact me, reach out to me. I have scheduled office hours to assist you. Please make sure to schedule enough time during the week to work on the assignments. That way you are not struggling on the weekend when I am not available. And you have questions, so it's better that you work the assignments during the week. That way if you have questions during the week, I can address them for you. Okay, please read the problems carefully. You have check your works. That way as you're working them, you can make the necessary corrections and hopefully you better understand the assignments. 2 attempts are provided. The highest grade is retained. Okay, so I leave you with that. Until next time, have a wonderful rest of your week. Bye-bye.